Welcome to Forward Guidance. I'm Jack Farley, joined as always by my co host in crime, Joseph Wang. Joseph, great to have you here.
Hey Jack, good to see you again. Hope you had a great vacation. And
I
by the way,
did, yeah, go
for the
ahead.
guys who don't know, Jack's shows hit 1 million views today. It's a remarkable milestone, so congratulations to him.
Thank you, Joseph. I couldn't do it without you. You have been pivotal in it. I'm really grateful I got you on. Joseph, so I was on vacation, didn't look at CPI, PPI, didn't look at housing starts, didn't look at the Fed funds rate, let alone the stock market. And so my mind was completely empty, just hiking, relaxing. I come back, Joseph, and I'm like, Joseph, what do you want to talk about? And you're like, let's talk about Zoltan Pozsar's thesis on Bretton Woods III, 3.0, which is the most complex, abstruse, fascinating thesis that I've probably encountered in macro and probably just in all sort of intellectual pursuits. It's extremely broad ranging, and I was very humbled today reading Pozsar's dispatches. Of course, I'm talking about Zoltan Pozsar, the interest rate strategist, legendary interest rate strategist at Credit Suisse. Joseph, here's what I'm going to just give my 30,000 foot view take, and then I really want your help in understanding it and getting into the weeds. Basically, I think the argument can be summed up by the phrase that central banks can print money, but they can't print wheat and they can't print oil. And the problems that the global economy now faces are not problems that can be fixed by central banks, because a central bank, if there's a money market issue, central banks got it. Joseph, that's what you used to do when you were at the Fed, a senior Fed trader at New York branch, I might say. If there's illiquidity in the treasury market, they can fix that. If interest rates are too low, too high, they can fix that. There are all sorts of levers and pulleys the Federal Reserve can pull. However, if the price of oil is at $140 or $240, if emerging market countries are facing severe starvation because of war and shortages, there's nothing central banks can do. So that's my 30,000 foot takeaway. What am I missing?
No, that's a really good overview. And for you guys who don't know, Zoltan is like the gold standard for short-term interest rate strategists on the street. And what's awesome is that you can actually find all of his work if you Google it. If you Google Zoltan Global Money Notes, you can actually find it on the internet. He's very widely read. If you're interested in plumbing, you have to read him. And if you follow at the Bond Freak Randy on Twitter, he will also keep you abreast of his latest notes. So definitely check on Zoltan if you're interested in plumbing. So Zoltan's piece stirred up a lot of publicity because, like you mentioned, Jack, he gave a very good global macro overview of what he thinks is going on. And he's saying he's going to go a bit further than what you mentioned. Not just central banks can't print all this stuff, that what's happening now may suggest potentially kind of a new monetary order that he calls Bretton Woods III, where there might be kind of a split in the system, which previously was dependent upon a unipolar, a unified system where we had the United States guaranteeing, let's say, safety of the oceans and free trade, but now you have more risk now, and the system might bifurcate. Um, but I think maybe what Zoltan is best known about is his plumbing, and so he looks at this through a plumbing angle. And I think I'll give you a little bit of a overview of what he's talking about there, just to analogize. So Zoltan looks at the world through the lens of, let's say, money, and he uses a framework that Perry Merling, who is a professor in monetary economics and also a really smart guy that you guys should read up about. He has actually a free course series on the internet if you ever want to know about monetary economics. It's all free and it's really well done. So in that framework, there's money you can think of like a number of prices of money. One is par. The second is interest rates. Third is FX. And so from this lens in money, par would be, for example, if I have a bank deposit, let's say $100 in a bank, I'm able to redeem it for $100 in cash. So my bank deposit, which is really just a liability created by a bank, is able to trade at par with dollar currency. And of course, if you're a bank and you have reserves, you can redeem that for currency at the central bank. The second price of money is interest rates. Now that's the price of money for future money. So I have money today, and basically moving money from today to tomorrow. How much interest rate am I willing to forego, or do I have to pay to get that money today or to lend it out for tomorrow. It's what equates money today with money tomorrow. And of course, foreign exchange is just between dollars and other types of money. Um, he takes this framework and he applies it to what's happening into the real economy. So one thing that's really important to note is that in the monetary economy, when you have differences, let's say in par or in interest rates or in FX, the central bank can do a lot of has a lot of power to fix these things. If I go to a bank with a $100 deposit, and the bank tells me, "I'm sorry, I don't have any more currency," well, the central bank can step in and it can lend currency to that bank, and so then that bank can make good on that $100 deposit and give a $100 bill. Same for interest rates. Let's say that the interest rate I'm facing here is different from what a foreigner faces when the foreigner wants to borrow dollars abroad. Then the Fed can step in and do like FX swaps and things like that to fix that problem. And if you are a central bank that targets an FX exchange rate, like a lot of emerging markets, the central banks usually can do a lot to, let's say, protect a peg or influence how the currency strength or weaken it. So that's one side. And he takes this framework and he analogizes it to the commodities world. And I think it's a really brilliant way that he goes about thinking about this. For example, one thing he notes is that let's say you are a shipper, right? And then you have to get financing, you have to lease a ship, and then borrow money to lease the ship, buy a bunch of commodities, and then ship that over to, let's say, from Russia to China, and you get paid after you deliver the shipment, and then you can repay your loans. Well, that's a lot like basically interest rate, right? So you need money today, and you're going to pay back money later tomorrow after a period of time. Um, another way that he analogizes this is between, let's say, par. If I have a commodity shipment today and I'm sending it from China, Russia to China, I expect it to get there, right? Just like I expect to have change a deposit to a currency at a bank. So that's par. But if you have a world where the geopolitical stability is breaking down, you can't really assume that anymore because maybe that shipment gets confiscated by pirates or maybe by somebody's military. So that power is broken because there's more geopolitical risk. And when you have these frictions in the plumbing, you can have the central bank come in and save the day, like you mentioned, Jack. But when you have it happening in the real world, well, there's not a lot you can do about it. And so when you're seeing all this disruption that's happening right now, there's not a lot of ways to fix it. To fix it, you need political solutions. You need a unipolar world, or at least a lot of countries to work together. You need people to protect the shipping um, things, or you need to be able to have the ship routes work as they used to. Right now, what's happening, for example, is because of this disruption, you have a lot of Russian oil that's selling at a discount that has to be rerouted everywhere to end up at India or China, and that kind of extends the length of time, kind of like raising interest rates. And when you raise interest rates in the monetary system, you reduce demand. And when you raise interest rates, so to speak, in the real economy, you're reducing supply. And that's kind of what we're seeing right now. And so I think Zoltan's macro picture is that this is going to be very inflationary because fundamentally you're changing the global order. All these disruptions that were happening in the real economy, by analogy, um, there's no easy way to fix them, and they have inflationary implications.
And something I think, Joseph, is that not only is Zoltan saying that central banks are currently unable to meet the challenges of the supply chain, the commodity price surges head on, but that they never could because there's two different, there are two different realms. One of the nominal realm, in which central bankers thrive because they can fix problems by moving, $1 trillion from the right side of the ledger to the left side of the ledger. And then there's the real world where real oil is being shipped on real ships, and those ships are in real water, and they can't go on certain routes if there's a war going on. And there's nothing that Jerome Powell or any other central banker can do about that, right?
Yeah, exactly. We are used to a world where supply chains just work, and if you have a problem, it's on the demand side. And central banks are basically geared toward managing aggregate demand. You raise interest rates, reduce demand, inflation goes down, boom. But this other side, the supply side, there's a huge geopolitical element to it. It's a real economy thing. You need real ships to police the seas. You need governments to work together. That's out of the realm of central banks.
And Joseph, what have you made of the ruble's rebound? It dropped, I think, somewhere around 50% in response to the sanctions, but since then, the ruble has rebounded, and it's pretty close to its pre-war level, which is astonishing, given how powerful, or we thought at least, the sanctions on Russian goods were.
Yeah, that's a really interesting point. Well, when it comes to, so they basically have capital controls now. So when you control who can sell, who can buy, you can kind of shape the price. So that's something the authorities can always do. Um, and it's actually the textbook thing that you should do when you have a crisis like this. So let's say back in the let's say the Asian financial crisis, all the Western powers were telling the Southeast Asian countries you should have free capital flows, blah blah blah. And what happened was all the foreign capital and a lot of domestic capital just fled, and their currency imploded, and it made the problem even worse. By having capital controls, you're actually making the problem better because you're preventing a lot of money from panicking and leaving, and it gives you more control over the interest rates. Um, but I think what you're mentioning though is that there's a broader point here, and some people think that this has to do with invoicing in rubles instead of invoicing in dollars and so forth for energy, but that's not really the case, because if you really think about it, if you're paying Gazprom with dollars or paying with rubles, it's not that big of a deal. The um, so if I were to pay Gazprom with rubles instead of dollars, and let's say I'm a U.S. company, well, I have to go and get rubles somewhere, right? So I have to take my dollars and then I have to sell them to someone, probably the Central Bank of Russia, to get rubles, and then give rubles to Gazprom for gas. So at the end of the day, someone in Russia owns more dollars. So that's not really the case. It's really more about the fact that there are capital controls, and also people in Russia are forbidden of owning foreign exchange. So if they have foreign exchange, they have to sell them for rubles, and that's the real source of demand that's strengthening it. It's not this invoicing in 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 rubles rather than dollars, I don't think.
Joseph, key to Zoltan's thesis is that the dollar reserve system will eventually fray, and that particularly offshore dollars, euro dollars, that creation process will stop for reasons I don't exactly understand. But and then because there are no euro dollars, there's no dollars to be recycled back into treasuries, and so that will cause interest rates to rise. What am I missing there? And then also, sort of, how are the mechanics of us moving to a dollar reserve system to a yuan reserve system, a Chinese yuan reserve system, which Zoltan indicates he thinks is possible, if not plausible.
Yeah, that's kind of the second big point that Zoltan's making. We're going to have the world is going to fragment from a unipolar world, and we're going to have a smaller, incipient, and growing RMB system. And Jack, as you mentioned earlier, there's no shortage of people calling for new Bretton Woods over and over again throughout the years. And oftentimes, it actually takes the form of of an RMB system. So I th a lot of times, what happens is that when, let's say, the U.S. buys gas or oil or something from a foreigner, or maybe buy goods from China, what the foreigners do is they take those dollars and they have to put them somewhere, and they put them in U.S. Treasuries, and that is a stable demand for U.S. Treasuries, and which is a really good thing because, as you know, the U.S. issues more and more Treasuries every year. We have basically a forever deficit. Right now, it's about $1.5 trillion this year, and it's estimated to be at least $1 trillion every year for forever. So it's good to have someone who's willing to hold those treasuries. If we go into a world where people don't really need as many dollars, and it's not because, well, it could because it could be because there are alternatives, but if there are fewer people willing to hold dollars, there's fewer people who need to invest them in treasuries, and that has implications for interest rates. If, for example, let's say China or the Middle East are beginning to use another currency like the RMB, then they're going to be looking for alternatives to park their RMB. They're going to have fewer dollars to park, and so there's less demand for treasuries. And I think that's actually a real concern. Um, Before this piece, Zoltan was mentioning that there seems to be a change in the safe haven status of the dollar because um, the US was willing to confiscate the central bank reserves by Russia. So what that means is that if you are a foreign central bank, like you're Russia or China, you have dollars that you use to support your currency, and you have to put those dollars somewhere. Um, Unlike you or I, they don't really put it at a commercial bank. They usually put it at another central bank. And if you put it at another central bank, you're depositing it with another government. So that's inherently political. And what happened this time is that those reserves basically got confiscated. And by willing to weaponize this, that means in the future, some central banks are going to be more hesitant to be investing dollars uh, in treasuries or in deposits at the Fed. It's a national security issue. Let's say you're like a huge country with a lot of reserves, and maybe you have territorial aspirations that are very important to you, but maybe not frowned upon by the West. Well, you got to be able to survive a world where your multi-trillion reserves get confiscated, right? And the way to do that is to diversify out of dollars. It doesn't have to be to rubles or something else. What Zoltan suggests actually is commodities, and it kind of makes sense. Commodities you own outright in your home, and they're actually useful.
But how would that work? People know what it's like to have money in a bank. A central bank knows what it's like to have reserves, to own treasuries, to own bonds. But people, what does it mean for a huge financial institution like a central bank to actually just own? What they're gonna have a bunch of in the basement? They're gonna have a bunch of gold and barrels of oil. Like, what's that going to look like?
Yeah. So actually, they do have a a lot of gold in the basement. Uh, so if you guys ever have some free time, you can go to the New York Fed. They actually have a gold vault tour, and they'll take you to a huge vault, 7 floors beneath the surface of Manhattan, and you'll see just huge gold bars. The gold bars are actually so big that the people who work there have to wear steel shoes because if they drop them on their feet, it just break their bones. So yeah, they actually do just hold gold somewhere. But I think what they also hold though, and we already do this, is stockpiles of commodities. Like for example, in the U.S. we have SPR. You have the exact same thing in China. Actually, China has enormous grain reserves too. US does as well, but they're not very big. So you can think of this as taking your enormous financial surplus you get from trade and just keeping it in the form of commodities that you actually use. Now, think about, let's say today we have riots in Peru because inflation is too high. Having a whole bunch of dollars, if they had a whole bunch of dollar reserves, that's not super helpful for them right now, right? They can go and they can buy grain, but the prices of grain have gone higher. If we're in an inflationary regime where globalization is breaking down, it makes a lot more sense to actually have, let's say, multiple supply chains and a lot of commodities, because that is actually what people need to live, not really digits in a computer screen.
Hmm. Joseph, true fans, you've got many true fans in the chat, and they know your theory of inflationary hikes, that interest rate hikes by the Federal Reserve could actually exacerbate inflation rather than curb it.
Yep.
What does the recent developments we've seen over the past 3 months, as well as Zoltan's thesis, in particular, how Bretton Woods 3.0 is going to be way more inflationary than Bretton Woods 2.0, does that make your theory of inflationary hikes more likely or less likely to be correct, and why?
So, the thing about inflation, so inflation means that the prices of everything costs more, right? That means if I'm an investor and I want to build a factory, all the steel costs more, all the labor costs more. I'm going to need a bigger loan. That increases the demand for money. And where does money come from? It's created by commercial banks, right? So if you have a supply short, if you have, let's say, this price shock and people believe that it will persist, then the price of everything goes higher and I'm going to need more money to do everything. And that kind of creates a cycle where, let's say, uh, demand begets higher prices and so forth. But with respect to the narrow part of inflationary hikes, now that has to do with the structure of the banking system. So you have an enormous amount. So banks in the past, they would borrow, let's say, short and lend long. That's the standard thing. But they don't. Their liabilities today are not really indexed to, let's say, LIBOR, because they don't borrow in the money markets anymore. It's all retail deposits, and that's due to QE, and that's due to fiscal policy. So as rates go higher, the banks are going to be more incentivized to create more credit. That's the big difference. As rates go higher, their interest margins increase rather than stay the same. They increase because your funding costs are floored at zero because there's so many retail deposits. And so as they raise rates to try to tame inflation, banks would be more willing to create credit. And as prices go higher, companies that need to borrow will need to borrow even more because everything will cost more. So in my view, inflationary hikes is still on. And
Inflation.
just just
Okay.
just aside from that, and there's another mechanism. Now this is a private sector mechanism, but think about the government now, right? Enormous fiscal spending every year, enormous interest rate bill. What happens to that interest rate bill when rates go higher? When rates go higher, the government, let's say $23 trillion in marketable debt, their interest bill goes higher as well, right? How do they pay for that? Well, they basically print more treasuries, so they borrow more. So then again, that's a doom loop. So if we get to a world where inflation is structurally higher, let's say interest rates to Fed funds goes to 5%, that's actually historically quite low. Well, what happens to the interest bill of the federal government? It explodes and basically escalates. It's a runaway train. So the whole world that we have is built on structurally low interest rates, higher inflation. It blows everything apart.
So if your theory of inflationary hikes hold, and we should note that this is contrary, most of what you believe is somewhat orthodox, but it's a pretty heterodox idea. It's fair to say. But if inflationary hikes is correct and your theory holds, then a lot bank lending in aggregate will explode higher.
Yes.
However, Zoltan is saying one particular niche of bank financing will not be strong, and actually will be a liquidity squeeze in that part of the market, and that is the banks extending credit lines to commodity players. So I understand very little about this market. However, I understand that the recent volatility in commodities, both up and down, has caused a lot of commodity traders to have their margins called and have their margins ratcheted up by banks. Zoltan's thesis, if I understand it here, and this is his piece that came out last night, quite hot off the press, is that there could be a liquidity squeeze there that could cause all sorts of problems. And he's comparing it to 2008. He's comparing it to the 2019 repo crisis. Joseph, what's going on here with these commodity players and the credit lines?
That is something lurking in the background, Jack, and I think you described it really well. So this is the basic problem of a commodities producer. So I invest a whole bunch of money, and let's say I dig up coal, and I sell that coal, right? But here's the thing. I have a bunch of coal, and the coal price fluctuates every day. So I'm worried. What if, let's say I dig up coal, and when I go to the market, the coal price fell. Then, my revenues go lower, and it's hard to plan that way. So to be prudent, what a commodity producer does is that it goes and it hedges its production in the futures market. So let's say it buys a whole bunch of coal. So say it mines a whole bunch of coal and then sells the coal forward in the futures market. So locking in the price. Okay, so let's say then when it has the coal, it can deliver the coal into the futures contract, locking down, and it doesn't have to worry about any price fluctuations. But here's the thing, though. Let's say it's a 30-day contract. I'm digging up commodities for the whole month, and then I already sold my coal forward, due for delivery in a month. The futures price fluctuates every day, and if you play in the markets, you know that you have to put up margin if your contract fluctuates a lot. Now let's say that coal prices are on fire, and so the futures prices keep going higher and higher and higher. That's okay for a coal producer because it actually has coal, and the coal that it has in the ground is becoming more and more valuable. But it is short that futures contract. And if you're short something and the price goes higher, you're in a lot of pain, and you have to put up liquidity. You have to put up margin to your broker. Now, you're good for this, right? Because even though the futures position is getting more negative, the actual physical coal you own is becoming more valuable. So you're actually on net, you're solvent, everything is okay, but you need liquidity to give to your broker to meet that margin requirement. And that liquidity need is not something everyone has, especially if essentially the prices exploded a lot higher, then those margin requirements could be enormous. Now, this happened to, let's say, the largest public coal company, Peabody, and they had to get an emergency loan from Goldman Sachs, and they had to issue a lot of shares. But it's not a solvency problem, it's ultimately a liquidity problem, as Zoltan and you just mentioned. Now, the thing is, a lot of these commodity producers, they're private and they're huge, and we don't really know how much exposure they have. So maybe they have bought a whole bunch of oil, which they own, and they sold a whole bunch of futures contracts short to hedge that production. So that's the prudent thing to do, and they are not insolvent because as oil prices go higher, their oil is worth more. But they need to have some liquidity to give to their broker to meet the margin requirements, and that those numbers could be huge. And I think that's what Zoltan is mentioning right now. This liquidity squeeze could be very large, and he suggests that maybe central banks can come in and backstop it. And central banks, of course, will not do that. They've already said that would never happen. The reason that won't happen is that, well, for one, you have commercial banks who are ready to do that, and commercial banks are well equipped to do something like that, and they already have, as was what happened with Peabody. But central banks don't like lending to people that they don't regulate because you don't really know what happens to the money. So you notice that when they lend to someone, it's always, let's say, banks that regulate, or at least to entities that someone else in the government regulates, like a money market fund or a dealer. So I think that's a huge liquidity squeeze that could be happening. My sense is that the commodity sector is big, but it's not systemic. It's not going to be a problem. There's no interconnection between, let's say, the liquidity problems of a commodities producer and everyone else. But most importantly, there's no solvency issue. So if you're willing to you lend that, you're going to get your money back because it's backed by commodities that have gone up a lot in value. So it's not really a big risk to a bank, and you'll find lots of people willing to lend.
But what if the risk to banks isn't that it goes up, but that it goes up and then it goes back down? And like it did in the case of Newcastle Coal, which is, I think, a futures contract of coal that went up something like 300% last month, and then it's crashed down, I don't know, 50% down there. So if at the peak the bank loan manager was like, oh well, yeah, we'll lend against this coal, it's going up, and then it wouldn't be good. So it's they would have lost a lot of money. So it's commodities don't just go up, even though the structural trend might be going up. It could be extremely choppy. That can be hostile to bank profitability. And if that is the case, Zoltan is in the camp, if I understand him, that the ECB or the Fed has to supply emergency lending assistance, ELA, or just flood the system with reserves via quantitative easing again, which again, to people who read Wall Street Journal and Financial Times, they would be shocked by that because like, oh, isn't it doing quantitative tightening? Zoltan thinks not, right?
Yeah, so I think Zoltan's view is that if there's a huge liquidity need, maybe the banking sector would need more reserves than you otherwise thought they would, because now they have this huge need to being able to backstop the commodity producers. Now, that could be true, but it's really hard to know, and I'm kind of skeptical as to how big this problem is. So you're right that there's volatility here in the commodity prices, but this is a perfectly hedged trade. You own the physical and you're selling the futures, so it's a liquidity issue, not a solvency issue. In theory, the prices move together, right? So if you're losing money on your futures contract, you're making money on your physical commodities. It's a basis trade basically, and eventually it converges when the contract is delivered. The volatility is not good, and it'll make the broker stomach churn and the commodity people really upset. But as long as they can hold through, they're going to make that they're going to make money.
Zoltan, sorry, I called you Zoltan. Joseph, I know you have a ton of respect for Zoltan. I believe you've read pretty much close to everything he's written.
Yeah.
But
Zoltan is awesome.
Yeah. And I obviously have tons of regard for him as well. It sounds like you do disagree with Zoltan's this aspect of Zoltan's thesis, because I've got it right in front of me. Zoltan says central banks are on, regarding the commodity pressure. Central banks are on the hook either way. They just don't realize it. And he lays out 3 options that central bankers can resolve this commodity issue. No emergency liquidity assistance to commercial banks. So no ELA is up, number 1. Number 2 is ELA for equity, which is kind of a central bank nationalization option. And number 3 is ELA on an unsecured basis, which is kind of like the moral hazard 2008 option. These are just such wild scenarios that are, I think, part of the reason that theory has taken the financial world by storm is just because these are scenarios that you don't think about that often, right?
Yeah, I think he's really envisioning a world where the commodity producers are in big trouble. They could be. I mean, you don't really see it though. I mean, let's say look at the producer prices. They're going to the share prices are going to the moon. So the commodity traders that we know, for example, let's say, I think the private ones have noted that they have some trouble. So maybe some people in the space, the traders have some problems, but overall as a sector, I mean, a lot of the producers seem to be doing fine. Their share prices keep going higher, and the market is not always the best measure of information, but it seems like everything's okay. And listen, if I was a bank, I would happily make these loans. You really don't need a central bank to do this. Banking sector has a lot of space to make loans. Making this it's kind of a sure thing because it's secured by commodities. So I think unless there are political reasons for not letting them being able to lend to these producers or traders, it doesn't seem like it's going to be a problem.
So Zoltan thinks that quantitative tightening is unlikely, or that it's unlikely it will be successful, and the Federal Reserve, central banks will be forced to inject the financial system with liquidity. That's interesting, Joseph, because we got a note from the news today that Federal Reserve Governor Lael Brainerd indicates that quantitative tightening is imminent, and that the Fed plans to reduce its balance sheet as early as next month while doing a rate hike. And actually, probably 2 rate hikes. That's what the market is pricing.
Yeah, they're going to do that.
QT and 2 rate hikes. I was just looking at the Fed funds futures. Like the terminal rate is something like 3.2%. Joseph, I know you're an inflationista. I know you think the Fed's going to be aggressive, but is there some point at which you think, hey, actually, I think the market is overestimating the degree to which the Fed is going to be hawkish, or are we nowhere even close to that point?
So I think the market is misunderstanding and misunderestimating the Fed. I think there are many people who don't understand that the Fed is fundamentally different now. They're very worried about inflation, and they're going to be very aggressive. Now, we saw today, let's say the 10-year went up 15 basis points. And for those who are worried about the inversion between the 2s and the 10s, it uninverted. So, recession is over, right? So I think we have much higher to go for the longer duration rates. I think we'll know more tomorrow. So tomorrow, what's going to happen is that there's going to be Fed minutes out, and they're going to spell out how the Fed is going to do quantitative tightening. And Brainerd has already teased it's going to be aggressive. And I wrote about this a couple of weeks ago. It's going to be aggressive. And I think, in my view, it will meaningfully steepen the curve. So rates are going to go higher throughout, and it will be steeper as well. The market understands the short-term rates, the path of short-term hikes really well, and market is always very good at that. So we can see up to the 5-year going up a lot. I think what the market doesn't yet fully understand, or maybe it does, we just don't have enough people being able to put on those trades, is that say the 10s and 30s are going to go up a lot as well. And I would expect that to, it's starting today, and it would continue tomorrow. But we'll see. I mean, listen, this is what the Fed, guys, we all know the trope, right? Don't fight the Fed. Don't fight the Fed. The Fed is telling you that it wants to have a steeper yield curve and a higher rates. So, Fed has a lot of power in controlling things like this. So I would keep that in mind.
Joseph, the first time we did our interview, it was in mid-December, and you made a series of 3 predictions. They weren't predictions, but you said this is your base case, that the Federal Reserve would be extremely hawkish relative to expectations, way more hawkish than people were thinking at the time. I mean, the terminal rate then was, I don't know, like probably lower than 2%, probably way lower. That was prediction number one. Prediction number two, it would be bad for stocks, which follows from point number two. Point number one. Point number three is that it would also be bad for bonds. And that cocktail of, so not only is it, impressive to have seen each of those things, but each of those things together, because historically during a tightening cycle, the long end, it's very good for bonds because the economy is slowing, and so bond, it's pricing in a recession. You should buy bonds. However, people who have bought bonds over the past four months have been absolutely annihilated. So, Joseph, I'm not saying you've got a crystal ball. I'm just saying that you've had an extremely good track record since I've gotten to know you. Probably better than anyone else has. So, what are you seeing for, let's say, December 2022? December 2022. I know you're viewing that you think the Fed's going to be very hawkish. How do you think it's going to impact the stock market, and how about the bond market?
Well, first of all, thanks for your kind words. So, I think I've been saying quite bearish on the stock market since January, and I've been telling people to be very cautious. And you know what? We did go kind of basically kept going down. I didn't expect us to have this huge rebound that we have right now, but I expect it to fade, and I expect us to go retest bottoms and beyond, actually. So the thing is that I think looking at the bond market and through the lens of, let's say, recession or not is not the right framework. But even if it is, it's being misapplied. So if you think about a recession as having slow growth rates and you buy bonds, sure, that makes sense when inflation is also stable. But when inflation is rising and not stable, then you can have lower real growth, but still higher nominal yields, right? That's because inflation is rising and bonds are nominal assets. So it doesn't make sense even within that framework. And to be clear, that's not the framework that I use. I expect rates to be, I expect the 10-year, let's say, to be north of 4% by year end. And I think stocks made the highs for the year, and we're all correcting from here on. One thing that I would note, and I suspect what's happening, is if you looked at the dollar strengthening a lot, and that's a lot of people from abroad, let's say in Europe, afraid of what's happening over there and moving money to the US. They're not necessarily buying bonds. They could be buying, let's say, Amazon or Microsoft, basically the US blue chips as well. And that gives some support as well to the US stock market. But that's not going to last forever. But I think that's helping right now. So we'll see.
Joseph, the fundamentals for the bond market in 2021, in terms of inflation growth expectations, were abysmal. I mean, growth accelerated and inflation exploded higher. And yet, if you actually bought bonds in March, admittedly after a huge sell-off, March 2021 until December, you would have had a pretty good year. And the argument that gets floated as to why that's the case is because European investors bought treasuries. Japanese investors bought treasuries. There was a relentless bid from foreigners who have much lower rates. So if Japanese bonds are yielding zero, a 1.8% 30-year treasury, that's so juicy. Whereas to you and me, it's like, it's crap, and it is crap. But to what degree do you think, I'm familiar, how are those interest rate differentials looking now, given that rates have surged so much in Europe, and then anything else you're seeing in sort of foreign fixed income markets that would indicate a healthy, robust bid for treasuries?
Jack, you hit the hammer on the nail, and Powell mentioned that as well, right? There's a lot of foreigners outside buying treasuries, keeping a lid. So I think two things I would say to that. Well, the rest of the world is raising rates as well, except Japan. Except Japan, they're maybe they'll change their mind. But they seem to be quite intent on maintaining yield curve control. So that's one thing. But the second thing is that if you're a foreigner buying U.S. Treasuries, which you have to hedge the currency. So let's say you're earning, let's say, 2.5% on a 10-year. Well, you could lose that in just one FX move, right? 2% in FX markets is nothing. So if you are an institutional buyer in treasuries, unless you're making some kind of currency double play, but mostly these investors are conservative, they have to hedge the currency. Hedging the currency is basically borrowing dollars in short-term money markets and investing in treasuries. That's another way of thinking about it. As the Fed hikes rates, those hedging costs become higher. And because the Fed has a very, very steep trajectory in how it's hiking, those hedging costs will become uh, higher very quickly. So whatever FX hedged yield you're earning right now on treasuries, it's going to get smaller and smaller very quickly. So that was a tailwind, but I think it's going away now. And I think it'll go away pretty quickly, definitely by the end of the year, since we're expected to hit, let's say, 2% on the funds rate, at least.
This is way above my head, Joseph, but doesn't that dynamic also play in reverse, where if the ECB is expected to hike extremely hawkishly, even more so than the Fed,
Yep.
then that would actually, on a relative basis, cause the hedging costs to go down. So, what are you seeing in terms of the forward rates markets, if you will, in Europe, Asia, everywhere in the world? I know the Fed is ridiculously hawkish according to the past 10 years as a standard, but what's it looking like in Europe? What's the forward rate market looking like in Japan, in China, in Australia?
Yeah, that's a really good point. So the ECB is projected to be hawkish, but their hawkish is nothing compared to the Fed. I think it was 3 hikes. I'm not really sure at the moment, but that's just nothing compared to the Fed. I don't really worry about that. And of course, Bank of Japan is quite intent on their policy, holding the stance of their policy, but things could change, so we don't really know. Um, I would think that actually the ECB might try to push back upon what the market is implying. And so that, I think, puts further downward pressure on the euro, probably very significant downward pressure. The ECB is a strange organization, and if you watch their press conferences, you can kind of see that some of their leadership, and to be clear, there are some very good and smart people there. Uh, I really like Isabel Schnabel. She has great speeches and all that, but a lot of the people who make big decisions there probably don't have any expertise in monetary policy. So it's not easy to see what they will do, but it seems like they might actually push back on what the market is suggesting.
All right, we got a question from CG, who's followed me. CG's been a loyal watcher of forward guidance for a while. Question for Joseph: do you see any reason at all for the Fed to do an emergency intermeeting rate hike?
No. So I don't know if they've ever actually they probably have once upon a time, maybe Greenspan. No, why? So
CG
so
said.
to,
CG
to be
asked.
perfect,
Yeah, go ahead. Sorry.
yeah, to be perfectly clear, the Fed doesn't need to do emergency meetings to hike rates. All that it has to do is, Jay Powell just calls in the Jim Cramer and said, I think rates are too low. I think they should be higher. And boom, rates would be hiked immediately. This is
Yeah.
what forward guidance is all about. So
Or
they don't really
or
need.
or our friend Nick Timmeros, right?
Yeah, exactly. Yeah,
Yeah.
exactly. So they really don't need any emergency meetings to do hikes. So, uh, but I think that they are very worried, and so I think that's why you have Brainerd today coming out and basically saying we'll have rapid QT because they want you to know that the curve is too low. No,
The
not
curve
steep
is too
enough.
low. That's saying
No,
something about the level of the curve, but not the shape.
sorry. Yeah, the curve is not steep enough, and the levels are too low. Yes,
The
you're right.
curve is not steep enough.
And the
Again, okay.
levels are
So
too low.
this is your view is that quantitative tightening will steepen the curve, not flatten it.
Yes.
And you have a lot of very very complex, interesting reasons why you think that. But I want to just bring us back to the present day. So you say by the end of the year you think the 10-year will be at 4%. Where do you think the 2-year will be, given that, unless my math is wrong, we have six. The 2-year essentially reflects what the Fed is doing and rate expectations. So, by the end of the year, what do you think the 2-year will be, and where do you think the Fed funds rate will be?
Well, it's an interesting question. Um, maybe 3% for the 2-year actually. Fed funds, I mean, that's whatever's in the market is about right. So uh, 2 to 2.5, something like that. So I'm not. So I think the way that I would look at this is that it's going higher, but at some point it's going to break, and this is what happened during repo. And in my core view is that this will happen in the long end. So exactly where it stops in my view is when it breaks. And I don't know exactly the time or day. I just think that it will happen. And then that will force an emergency intervention, quantitative easing, yield curve control, something like that. But in my view, that is the end game, some form of yield curve control.
You mean it breaks, meaning bonds sell off so hard and yields
Yes,
spike higher?
uncontrollably. Yes, that's what I view as what would actually be the end. It doesn't like stop somewhere. What you're doing in the quantitative tightening, in my view, is reckless, and so it will break the market. By break, I mean there will be an uncontrollable spike that will restart quantitative easing of some type and probably roll in yield curve control. Um, exactly when that happens, I don't know. I just know that this is a machine. It's unstable. As time goes on, something in my view is likely to crack.
Mm. Wow. And so this yield curve control that you envision will be not like the Bank of Japan's first yield curve control to stop yields from going lower, but the second version to stop yields from going higher.
Yes, the conventional way that you would think about this, like the
Yes.
Bank of Australia way.
See, Joseph, I've learned a lot from you. So Joseph, to close this out, we've got a series of fantastic questions from the audience. So I'll quickly say, someone says, so Bitcoin is going to be wrecked. Ray says that. I would just offer that I'm not entirely convinced that the reason for Bitcoin's huge bull run in 2020 was because of the expansion of the Fed's balance sheet. If you look at the huge bull run in all crypto in 2016 and 2017, that was during a very narrow window of relative hawkishness when the Federal Reserve was hiking rates and enacting quantitative easing, although not at the same time. So that's just my little hobby horse. Now let's get to some questions. Ryan Melby wants to know, will Treasury issuance match this desire to steepen the curve? Yellen has some power here. I wonder if that is relevant relative to Andy Constant's thoughts on the short end of the curve.
You guys. So, very very good question. So when you do quantitative tightening, what happens is that the Treasury issues new debt to repay the Fed, and the Treasury has power as to where along the curve it'll issue. It can issue a lot in the 10-year, a lot in the 30-year, or it can issue a lot in the short-dated plate. The thing is, though, that the Treasury has some guidance that it tries to adhere to, that it wants, let's say, bills, viciously short-dated Treasuries, to be less than 15 to 20% of total issuance. It's about in the middle there. But that's not really the point, though. The point is, even if they were bonkers and they issued a whole bunch of bills, let's say got that to above 20%, that share to above 20%, the bulk of the issuance, the great majority of it, would still be in longer dated tenors. And also, if you're thinking it from a the debt management perspective, they're actually incentivized to issue longer dated treasuries to lock in low rates. It's like if you're getting a mortgage, right? I mean, you're afraid that rates are going to go higher. Well, rates are still historically low. Well, you should take out a mortgage, and the Treasury thinks the same way. Yeah, sure, 10 years at, let's say, 2.55. That's still historically low. I should take advantage of that. So it's in their interest to lengthen their duration.
Joseph, I'm really glad you brought that up. I actually just today interviewed Roger Lowenstein, financial journalist, author of When Genius Failed, about 1997 long-term capital management. He's a new book about the Civil War, and so we're really getting into the weeds on the plumbing during the 1860s. And the North was able to secure long-term financing. They were able to issue bonds, long-term bonds, and whereas the South relied on short-term notes and certificates, and they constantly had to refinance, and that was incredibly inflationary. So based on what I've learned from history, at least from reading this book and speaking to Roger, which, by the way, that interview airs on Sunday, definitely you should check that out.
Look forward to it.
Thanks, Joseph. Is that, the longer the duration, the less inflationary the money printing is. So what if Yellen does the Andy Constant plan, which I don't think Andy actually wants, thinks that she will, and issues all of this short-term debt that can use the money that's in the reverse repo facility to, basically not using bank reserves, that because money market funds can buy, they can't buy coupon paper, so they can only buy short-term stuff. Basically, if she does that workaround, would that just be ridiculously inflationary?
So I think it could be inflationary in the sense that, let's say the Fed hikes the short-term rates to 2.5%, 3%, then that kind of rapidly increases the interest rate costs the government has to pay, right? And how does the government pay interest rate costs? Well, it just prints more treasuries, right? So that could be inflationary in that sense. Um, yeah, so if instead they locked in, let's say, low 10-year yields, then even when short-term rates went to 3.5%, then they'd still be paying 2.5% rather than, let's say, increasing their interest rate expense with short-term rates. So that I think that's the angle that's the lens that I would look at this at. So they could just cut rates to zero again, and then short-term rates would be even cheaper than longer-term rates. But that's not the trajectory we're on.
Joseph, we've got a comment from Ralph who says, all caps, smash the like. And yes, please, people watching this, smash the like button. And actually, don't just smash the like button. How about you go ahead and smash the subscribe button. Subscribe to the Blockworks YouTube channel.
Fancy.
Yeah, Joseph, I'm like a video editor now. I'm a producer. And by the way, just for the people watching, Joseph, you and I have been talking. We have lined up all of these guests over the next 2 months.
Yes.
So we've got this is the Jack and Joseph show, really the Joseph and Jack show. That's going to be every single week, and we're going to have hard-hitting guests, on FOMC day, on all of these important events. So stay tuned, and you don't want to not miss that out because you were dumb and didn't subscribe to the Blockworks YouTube channel. So while I'm in my plug mode, people have got to follow Joseph Wang on Twitter at FedGuy12, and definitely read his stuff at fedguy.com and his book, Central Banking 101. Joseph, now that I've gotten all my plugs in, I gotta say, got a great question from this guy called Mud. If you were Fed chair, what would you do to tamper inflation?
I think Jay Powell is doing the right thing by raising rates. This is what I would do, though. And so Powell over and over again tells you that we can raise rates, but it'll be a soft landing. You're not going to hurt unemployment, not going to hurt the economy. Everything's going to be okay. I would actually stop with that framing, and that's just ridiculous to me. So, there's always a trade-off in everything you do. The trade-off to fight higher inflation is to have a little bit more unemployment. That's just how things are, and that's what we've always been able to understand as a society. It's not always sunshines and rainbows. Sometimes there are hard trade-offs you have to make, and it's strange to me that we can't even tell it straight to people that this is what's going to happen. It's not good, but we also need to get inflation under control. So you have to stop sugarcoating it and just be honest.
Joseph, I think I asked you that same question in December. I said, what would you do if you were Jay Powell? And you said, I'd be screwed.
Well, yeah, now if he started hiking rates now, I think things would be a bit better. But he was slow, and now he might have to go faster than anyone expects. And if you look at the short-term interest rate markets, yeah, he's pressing in a lot more hikes now, 250 basis point hikes than it was before.
We got a funny comment. Raise rates 20,000 basis points overnight. Problem solved.
Yeah, it would solve. We wouldn't have inflation. We wouldn't have anything to worry about, or everything would be we'd be living in caves.
Yeah. Well, Joseph, I don't think I'll have time to explore it now, but it sounds like you're someone who still has some regard for the Phillips curve about the relationship between inflation and unemployment. We'll have to explore that on a later episode. But Joseph, it's been great having you as always. And yeah. Well, I know what I want to ask you. Yeah. What the minutes are going to be released tomorrow from the previous FOMC meeting. You and I expect it to be extremely hawkish. But what would have to happen where it's just such a juicy news thing? It's like even you didn't foresee this, that you and I would have to do an emergency podcast as soon as they're released. What would that level have to be?
Release this and Dow went down 1,000 points.
What do you say?
Dow goes down 1,000 points.
1,000 points.
Well,
all
actually,
right.
I'm not even sure 1,000 is that much anymore, right? How high are we?
It's like 3%, right? Was we at 30,000?
No, that's not. It's 5% is the threshold. 5%. Yeah.
Give me 3.8.
3.8. All right. 3.8.
Right.
What's 3.8 in points? All right.
Yeah. All right. Well,
we'll
Joseph,
find out tomorrow.
Yeah, we'll find out tomorrow. Joseph, thanks so much.
Yeah, and guys, remember we do have a great list of speakers for the coming 2 months. From the smartest people, most interesting people, many of you have heard of, on FinTwit. So we're going to try to keep the show with a big line of people from FinTwit and from the financial that you'll be interested in. So you won't just have to listen to us all the time.
Yes, definitely. And we'll give him a sneak peek. Next Tuesday will be George Goncalves, who understands, he's on Joseph's level in terms of understanding the plumbing, which yeah.
George is a great race strategist. It's going to be a great episode. And if you guys don't already follow him, you should check him out.
Yeah, George is fantastic. So that should be great. And thank you everyone for watching.
All right. Bye.
Bye.